Hey guys, how you doing? So Dan from Trading with Dan here. So today we're going to have a quick look at this article that I've seen on Zero Edge. Zero Hedge for most people that can read properly, but I just call it Zero Edge because it's pretty much Zero Edge. Anyway, so oil plunges to 17-year low as one bank predicts negative rates. So that's what I wanted to talk about. Sorry, not negative rates. I'm so used to saying negative rates because obviously banks like the ECB has negative rates, but no, negative prices. So oil at negative prices, as in you get paid to take the oil away. Right, so let's have a look what it says. So late in Tuesday, WTI plunged as low as 26.20, so obviously it's lower than that now, taking out the lows from the 2015-16 oil recession and sending it to a level last seen when US President George W. Bush, people were listening to Get Busy by Sean Paul, and Dogville was one of the most popular movies, so in 2003. Whilst there was no immediately clear catalyst, earlier in the day, Goldman's commodities team published a report in which they discussed the need for commodity prices to drop below cash costs to generate supply curtailments, as demand losses across the complex are now unprecedented, as Goldman now believes oil use is down an unprecedented 8 million barrels per day. So what they're saying is that they think that supply needs to come offline, so the price needs to come down further to knock out supply, which funny enough is what we have spoke about with what Russia and OPEC and Saudi Arabia are maybe trying to do to knock out US shale, basically, which is basically what Goldman is saying without actually mentioning US shale. But they'll be fully aware that they're obviously the highest cost producers of oil, and Saudi Arabia and Russia and Mexico, etc. have lower costs. So large commitments from core OPEC for April-May deliveries pushed the net supply increase to near 3 million barrels per day, which combined with the demand loss results in an April-May surplus of 7 million barrels per day, which will likely breach system capacity in Q2 2020, so the second quarter of 2020. So as Goldman's Jeffries Curry wrote, the system strain creates a physical end, even though the virus will end is unknown, pushing our forecast to shut in economies. We now forecast 3 million, I'm not sure what that stands for, 25%, maybe it's global supply, something. As a result, the price wars in oil and gas and uncertainty policy responses in the bulk and base metals, all a direct result of the sharp fall in demand resulting from the virus containment measures. Goldman has cut quarter two bench Brent price target to just $20 per barrel from $30 per barrel. But that is not the worst of it. For what little is left of oil bulls, outdoing not only Goldman but virtually every single bearish oil analyst in existence, Mizu Paul Shanky not only estimates that Goldman is too optimistic by half, cutting a whopping 50 million barrels per day in oversupply currently, but the crude price could go negative. Yes, as in you would get paid to take delivery as Saudi and Russian barrels enter the market. So according to Sankey, much of the US 4 million barrels per day in crude exports will be curtailed as supply falls and tanker rates soar. So that's the storage on tanker rates. With the US storage roughly 50% full and able to take another 135 million more barrels more. Assuming a build rate of 2 million barrels per day, the US can add 14 million barrels per week for 10 weeks until full. Said otherwise, absent drastic changes in roughly 3 months, energy merchants will be paying you if you generously take a couple of million barrels of crude off their hands. So what this is saying is that you've got there is a cost in shutting an oil site down, an oil well down. So there is a cost, so they don't want to necessarily shut them because then there's a cost to shut them and then a cost to start them, and then also there's a storage cost if we have like a global glut of supply. So the actual we'll run out of basically places to put it, and that coupled with the fact that there's a cost in shutting down could result in negative prices. So that's obviously going to be wholesale prices. It's not going to be negative at the pumps. For a start, obviously there's going to be there's always tax on your petrol anyway, or your diesel when you pay at the pumps, but also yeah, I mean that the cost would then have to be paid to store it, which then would be then passed on to the consumer. So we aren't going to be getting wholesale negative prices. But yeah, in the wholesale market, there is the potential, due to the factors of there is a storage cost and there is a cost of shutting oil wells down, that could result in negative prices. So it's a crazy world, guys. But people never thought we could have negative rates, and that happened. So anyway, so remember, it's not a financial advice. Thanks for listening, guys. I'm not a financial advisor. Disclaimers in the description. So yeah, like, comment, share what you guys think to that, and I'll speak to you guys later.